Hello student, welcome back to our ongoing chapter. We are studying financial management. Yesterday we have studied our core meaning of the finance, and we study about the core financial decisions related with the investment, financing and dividend. Today we are moving ahead and we are going to discuss the financial planning. What is the financial planning and how it will be helpful in your organization and how you can understand its deeper informations about how the organization is able to manage their finance and how they plan their finance in a very effective manner. So first of all, I need to focus the meaning of the financial planning, then we move ahead. So what is the meaning of the financial planning? Financial planning is the preparation of a financial blueprint of an organization future operation. It forecasts fund requirements, their timing, and sources to ensure the smooth business functioning. It is basically related with how you plan your finance, how you bring the money into your business, how you make a blueprint, how you are collecting the funds for your business. So this is your financial plan, right? So financial planning is a preparation of financial blueprint of an organization future operation, how the organization will do its future operation, related with what, related with the fund requirement, related with their timing, when we require, how much we require, and their sources, where we will require, right? How much fund we require, when we required, and what are their sources, and how we will collect from that source. So it forecast fund requirement, timing, and sources to ensure smooth business functioning. Because it will basically related with what you have collected the fund, you may have a proper timing about the fund in the time when you need it, and last, where you have collected this source, where you have collected this finance, so that you can continue your business, so that you can make smooth functioning of your business. So this is how you do your financial planning. Next, there is again a twin objective of the financial planning. First, to ensure the availability of funds whenever required. It will focus on estimating the total quantum and the exact timing of the funds needed for a long-term assets and the day-to-day expenses. So this is the quite clear. You need a fund, but it is estimating the total quantum. Quantum means how much money you will need it, and at what time you will need the fund, at what time you will need the money for your long-term assets and day-to-day expenses, so that you can manage your business in a very smoothly. Next, to see the firms does not raise source unnecessarily, you have to justify that. You need to focus yourself. You should focus on preventing excess funding, right? You cannot withdraw the money from the sources when you are not required. So you should prevent yourself from the excess funding, which create the ideal resources and unnecessarily increase the cost. Suppose you need 10 lakh rupees and you withdraw 15 lakh. 5 lakh that you have withdrawn extra will be ideal for your business. It is ideal resources, but still you have to make interest on 15 lakh. You are using only 10 lakh, but rest 5 lakhs are in a idle mode. So you are paying for whole 15 lakh. You are paying interest for whole 15 lakh. So you should be very careful about that. You should avoid taking extra money, or you should avoid taking extra finance from the particular sources, right? So this is the twin objective of financial planning. Now, what is the importance of the financial planning? So there are few points that you can see over here. Prepare for the future. It helps forecast alternative business situation and the dynamic changes. It's a very simple. It will help you to prepare for the future, how much money you will need it for your business, its situation, and how much money you will require if there any condition exists that is totally dynamic to the situation, dynamic to the business, and you are not aware of earlier for this kind of situation in your business. So you should prepare for the future. Second, you should avoid business shocks. Minimize structural surprises by planning operational contingency in advances. So it is saying that you need to minimize structural surprises by planning operational congruence in advance, right? Business shocks happens when your planning, your organizing is not in a proper manner. You need a fund as per your planning, but your business demand more money. So you should focus on at what point, at what condition business need this much of finance. Do really have to raise the finance from the particular source, or do we do and work do we can work with this amount of money that is not required further. So you need to minimize the structure surprises by planning operational congruence in advance. Next, you need to coordinate business function. Link separate segments like sales and production via unified policies. We need to coordinate the different business function related with the sales, marketing, production. So you need to link them. You link them in a unified policies, because you will design a policies in which you require this amount of money. So you think that, am I able to manage the things with this amount of resources? Suppose I have taken a 25 lakh from a particular bank or from any other sources. So am I able to manage this fund for all our business, for all our different departments? So you should think in that way. That's why you need to coordinate business function. Fourth one is to reduce organizational waste. You need to minimize the operational duplication of the efforts and the planning gaps. Reduce the organization waste. Organization waste usually occur when you have a duplication of the effort, right? You are doing the same work time and again, then resources are being deployed, resources are being utilized. So you should be very careful where you can minimize your operation duplication of efforts, and where you can remove the planning gaps. You did the planning in a very good sense, you are organizing the resources, but you should focus on what are the tasks, what are the area where we need to reduce the duplication of the effort, where we need to reduce the gaps that are existing in the planning. So it will help you to reduce your organization waste. You will save your money, you will save your energy, you will save your time, and every time you will be more careful about your fund, about your business, about its operation. So as much you are concerned, as much you are identifying your true aspects of your business, definitely it will help you to foster your deeper understanding about your business, and y- you can make improvement in your business where actually your business required money or not. So in this way you can focus on your different aspects and you can reduce organization waste. Next, now links present with the future. Establish a concrete path connecting current status to the long-term goals. You should focus on this point very carefully, because this point is very much relevant, because this will connect you from the present to future. So there should be a path that will help you to connect from the present current situation of the business to the future business condition, or future projected value of your business, future projected aspects of your business, future projected revenue of your business. So you need to establish a concrete path connecting the current status to the long term goals. If you want to achieve a long term goals, you are focusing and you are ponder over your different aspect of your business, and you are very much concerned to achieve your long-term goals in a very significant manner efficiently, then you must design the path which are connecting the current status to the future one, right? So you should be very careful about how I can manage my present situation, how can I draw the path for my future or the organization. So you should be very careful about the same. Next, connecting you are connecting the decisions that serve as a continuous strategic bridge between the investment and the financing choice, right? You are connecting the decision because we have already discussed about the different decisions: investment, financing, a dividend decision previously. So this will help you how you can connect your different choices, different decisions, whether it is related with the investment, whether it is related with the finance, or whether it is related with the dividend. So you should be very careful about your decision in this regard. So it will serve as a continuous strategic bridge between the investment and the financing. Because financial planning you usually do, you help you how much finance you needed, how much money you need to invest your business, how much money you will definitely invest in buying the assets, or how much money you will definitely invest or you will finance your operation. So both are interconnected, both are interlinked. So your decision should be in a such a way that both type of decisions or all type of decision, whether it's related with the investment, finance, and the dividend, should be carefully synchronized, carefully bridged with one another, right? So you should be very careful. You should be very careful about connecting the decisions. Next, it is the performance evaluation. Spell out detailed selections, objectives, make actual appraisal easier, right? This is very much concerned with the performance of your business, performance of the employees, but sometimes financial planning is related with the performance of the business. So it spell out detailed section objectives makes actual appraisal easier. The financial money or financial planning that you usually do, because you are very much careful about your business, you are focusing on the different objective, because you are bound to achieve different objective in a very synchronized way. You are able to achieve all those objectives with the finance you have in your company. That will help you to actually identify how much performance you have made while using this amount of finance, how much amount of performance you have made while using this much amount of money. You have taken a very good decisions, whether you have taken a very good decision about the investment, about the finance, about your dividend decisions, or your business is has been able to perform better with that money that you have borrowed or you have raised fund from the different sources. So performance evaluation will help. Performance evaluation would be made easy by using a financial planning, or it's very objective. So you should be very careful about eases the performance evaluation that is provided by the financial planning. Now we are moving on next topic, that is a capital structure, right? Capital structure is very much important. You must focus on this point because most of the questions are asked from this particular point, because it is a very practical one. In next subsequent pages, you will understand its minute situation and its very basics idea how the capital structure is designed in a particular company. So capital structures refers to the mix between the owner's fund and the borrower fund used to finance a business. It is commonly calculated using the debt equity ratio, right? Capital structure, what do you mean by capital structure? Capital structure means how much amount you will use as equity and how much amount you use as a debt, right? Equity is comes from the shareholder and debt comes from the bank or the other financial institution. So when you use both in a form of equity or in form of debt, it generate capital structure. Yeah, it design the capital structure. So capital structure is a combined form of equity and the debt. Equity is raised from the equity shareholder or say shareholder, or debt is raised from the financial institution or other banking institutions. So this way you finance your business. This way you start doing business with the help of that capital structure. So it is commonly calculated using the debt equity ratio. You need to calculate the debt equity ratio, how much debt you require in your business, how much equity you require in your business. So it will reflect on your business aspect. It will help you to foster the understanding, foster the deeper level of your business, or you can find where we need to make more investment through the equity, where we need to make investment more through the debt. So you are combinedly taking the help of equity and your debt to run your business. So in this way, you are learning about the capital structure and its meaning. Now we are focusing on a very important point. You can remind this point because this is a very important point that a question is usually asked from this point. So what is this? It is a trading on the equity. Trading on equity means this refers to the practice of increasing the profit earned by the equity shareholder due to the presence of a fixed financial charges like interest. This strategy is favorable only when the company return on investment is higher than the interest paid on the debt. So what we have learned from this particular point, it is simply saying that a investor will gain more profit, an investor gain more revenue if you are paying, or if you are generating more revenue, but out of that revenue you are paying less amount to the debt in terms of his interest, and rest amount you are saving for your investor. For example, 2 lakh if you are earning from your business, 50,000 you are paying in the form of interest that you usually pay for the debt, and rest 1 lakh 80,000, 1 lakh 50,000 you are using for the investor, and you are paying in the form of dividend. So this is how you are trading on the equity. More revenue you can generate by using the equity and debt, but if you are paying less interest in form of the debt or in against your debt, and more revenue you are saving in terms of profit, then you are trading on the equity, right? So in this way you have to pay less interest charges for the debt, and more you are saving for your investor. After paying the investor, still you have some money in your company's account. So this is how you are trading on the equity. So in this regard, we have to study one of the important point, and it is a very practical. You need to understand. You can focus on it. EBIT or EPS analysis. EBIT or EPS analysis measure direct impact of changing financial leverage on the earning per share of the equity holder. So this formula used for calculating the EPS, that is EPS equal to EBIT minus interest into 1 minus tax rate upon number of equity shares. So you don't worry, I will let you, or I will help you to I will make you help understanding this particular formula. So you can get insights about this particular formula by following a particular question. I have designed a question over here, and I have also added some of the important point that is help you to understand its EPS, EBIT, interest, after tax interest. So some of the point you can understand through this. Here I have taken a company and some of the information through that company. That is, total capital of the company is 30 lakh, interest rate on debt is 10%, tax rate is 30%, equity share face value 10 rupees per share. But as we have just studied about the trading on equity, this capital employed includes, or based on this situation, right? If this capital employed is having a base of equity as well as the debt, or whether it has only equity no debt, so this condition is given through this way. So if you are having a 30 lakh, but right now you have not taken any debt you do are not paying any interest, then number of shares would be equal to 30 lakh in terms of your equity share or equity capital divided by the 10 per share. So you are having a number of equity share is 3 lakh, right? In the same way, if you have a 30 lakh in your capital employed, but you have taken a 10 lakh of debt, interest you can pay 1 lakh, and 30 lakh minus 10 lakh divided by 10, and it is showing your number of equity share, that is only 2 lakh. And in the third condition, you have taken a 20 lakh in form of debt, you are paying interest of 2 lakh, as I have calculated the interest as also in this point. And 30 lakh minus 20 lakh divided by 10, 1 lakh is a number of equity share. Now, how you can use this information? For example, if you are earning EBIT, earning before interest and tax. Earning before interest and tax means the revenue company is raising from its business, generating from its business, still you have not paid. Earning before interest and tax, still you have not paid any interest, any tax, but now you are paying interest and you are paying tax. How much amount of money you have for your equity share hold, or how much revenue you are left with your left with for your equity share holder? So in this case, you will learn few of the key points on the next page, right? Here I have taken, for example, earning before interest and tax is 4 lakh, and three situation is here: when you have taken no debt, when you have taken a debt of 10 lakh, when you have taken a debt of 20 lakh. So EBIT in every case is same, right? Less. Now you have to reduce the interest for the first condition is 0, second condition is 1 lakh, and third condition is 2 lakh. I have placed the figure in a different situation as it is required. Then after subtracting the interest, it becomes EBT, earning before tax. It is 4 lakh as it becomes 3 lakh, it becomes 2 lakh. Now you have to reduce the tax rate. Tax rate is 30%. So uh, you have to calculate tax amount out of this profit. The 4 lakh, 30% of the 4 lakh is 1 lakh 30,000, 20,000. 30% of 3 lakh is 90,000. 30% of 2 lakh is 60,000. So you have calculated the tax amount as well. After deducting this tax amount, that is 4 lakh minus 120, 3 lakhs minus 90,000, and 2 lakh minus 60,000, it becomes after earning after tax, EAT that you say, right? Earning after tax. So this is the amount that is available for the equity shareholder that you can distribute to them. But how much per share you give them? How you calculate? So earning after tax for the first situation is 2,80,000. Second, for the second condition is a 2,10,000, and the third condition for 1,40,000. Now you have to divide by this number of share. For a first condition 3 lakh, for second condition 2 lakh number of share, and for third condition is a 1 lakh share. So you will understand that 2,80,000 divided by 3 lakh, 2,10,000 divided by 2 lakh, and 1,40,000 divided by 1 lakh. So this is what this you can calculating. This you are calculating the earning per share, earning after tax, and this amount is available for the dividend distribution. And per equity share will receive 2,80,000 divided by 3 lakh 0.93 rupees, or 0.105 rupees, or for 1.40 rupees. So what you are getting insight out of it? So you are getting insights that if you are using, for first condition, if you are using no debt, all amount of money comes from the equity shareholder, then you are paying only a 0.93 rupees for your dividend when you are earning a 4 lakh, right? Second condition, if you are earning 10 lakh, if you are say if you are using a 10 lakh as a tap, you are earning per share is increasing, right? And in third case, your you are using 20 lakh as a DAP, your earning per share is increasing. So this is the trading on equity, right? Here you are earning 4 lakh, you are giving zero interest on that. So in this case, your earning per share is this, because a huge amount of tax will you have to pay. Here you are paying interest on debt, after that earning after tax, and then you see suddenly a amount reduced to a 90,000 only, right? So earning before tax will give you an insight that you are paying less tax on it, or sometime you are paying the interest on debt that is a not chargeable. You have to pay no interest on debt. You have to pay no tax. Sorry, you have to pay no tax on the interest on debt. That's why you are available with the remaining amount, that is a 3 lakh, and now you are paying 90,000 as a tax, and remaining amount you are having in your hand, that is available for equity share dividend. So this amount is increased from 0.93 to 1.05. So what it is inside, what is referring to you? It is referring you that if you are having a no debt, then your earning per share is less. But if you are using a debt along with your equity shareholder, equity share capital, then your profitability would increase. In the same way, if you are having a more debt, then your profitability or your earning per share is increasing. But it all depends on one thing, that is your EBIT. If your EBIT is higher, you will definitely have a good amount of earning per share for a dividend distribution. But if you are having a very less amount of EBIT, then what would be the condition? So this case we will understand through the next situation. Here you are given with only 2 lakh in a form of EBIT. Here you are given with the EBIT of 2 lakh. First condition, same situation, nothing will be changed, only EBIT amount you can see it will be changed here. EBIT will be 2 lakh, 2 lakh, 2 lakh in every condition, rest would be same. But you will observe the difference. Here, when you are earning a 4 lakh, you are paying no interest. After paying the tax, you have earning per share this. But when you are having a less EBIT, less earning before interest and tax, but you are paying no interest, but after paying tax, you have a residue in form of earning after tax is 1,40,000, but your equity per share is higher. So your earning per share is less than this, right? So your revenue should be higher in order to take the advantage of trading on equity. When you are having a debt along with your equity capital, then your EBIT should be in such a condition that will help you to generate more dividend for your equity share holder. But here you will observe, when you have 50% of EBIT in form of 2 lakh, then your condition would be different. Okay. So here you will have 0.47. Here you will have the same situation but 0.35. So it is continuously decreasing, decreasing in terms of earning per share. So your financial leverage, favorable financial leverage give you to distribute more dividend. Your favorable financial leverage give you the chance to distribute more dividend to your equity shareholder. But if you are having an unfavorable financial leverage, then this earning per share will decrease significantly. So this is how you need to focus on two things. You should earn more EBI in order to pay the more dividend to your equity shareholder, even though you are using the debt or even though you are not using the debt. So if you have a favorable chance or favorable condition in terms of EBIT is of 4 lakh, then definitely it will help you to distribute more dividend, more money to your shareholder. Otherwise, it will not help you in any case. So hope you have understood this particular point, and this particular situation will definitely ask in the examination. Now, What are the factors? Choice of capital structures. Factor affecting choice of capital structure. We capital structure, it means you are using the equity, you are using the dividend as well, debt as well. But what are the factors that affect this decision? Whether you use a capital, whether you use a equity shareholder, whether you use a debt or mix of it, right? Either you can use equity capital, either you can use only debt, but we are favorable in a condition where we use both. So, what are the factors that affect your choice of capital structure in this case? So, first case is cash flow positions. Sufficient cash flow, sufficiency of cash buffers to meet fixed payment commitment. If your cash account is have a sufficient amount of cash so that you can make fixed payment commitment, it means you have to pay interest on your debt, that is your fixed commitment, you need to pay. So if you are having a sufficient amount of cash flow in your bank account that are used to meet the fixed payment commitment, then you can use it simply. Next, interest coverage ratio, number of times corporate earnings or cover interest obligation. Number of times corporate earning cover interest obligation. If your interest coverage ratio is sound enough, that will help you to generate more earning and you sufficiently able to pay your interest obligation, then you should go for it. Interest coverage, if your earning is able to cover your interest, you can pay your interest for the debt out of that earning, then you definitely go for this kind of capital structure in which you are using equity as well as your debt. Third one, debt service coverage ratio. Debt service coverage ratio means cash profit compared against the total debt servicing needs. Cash profit compared against the total debt servicing need. Total debt, whatever money you have taken from a sources. Suppose you have taken the 10 lakh, 20 lakh, 30 lakh, right? And your cash profit in comparison to your total debt servicing is not appropriate. Suppose you have taken a debt of 10 lakh and your cash deposit or cash profit is only say 7 lakh, then you are not able to pay your total debt including the interest at one go, at one instance. If you could have paid, then it will be a good situation. But if you are not able to pay that amount, then you are in a very risky situation. So definitely your cash profit compared against the total debt servicing need should be higher. Okay, so you should have debt in terms of money, suppose a 10 lakh, 20 lakh, and service in terms of interest that you pay on it. So your interest on your debt should be covered the amount you have in your cash account or your bank account. So cash profit compared against the total debt service need, if it is sufficiently available, if the cash is sufficiently available in your bank account, in your cash account, that are used subsequently amount of debt or interest suddenly, then you can use capital structure using the both combination. So this is how you can manage your capital structure. Next, return on investment. Return on investment is reflected by high return on investment enhance the ability to use the financial leverage. Financial leverage that we have already talked about. If you have a favorable financial leverage, you are having a good amount of return on your investment, then you can use your debt. Then you can use your say equity share capital. So higher returns on investment enhance the ability to use financial leverage. If you are having good amount of profit, suppose you have understood in example 2 lakh or 4 lakh. If I say 6 lakh is a return on investment, then it is a very good condition. You are using less amount of debt, you are using a more amount of equity. So in this case, you are progressively getting the more and more earning per share for a dividend distribution. So in this way, you are focusing on your return on investment. So this is the factor that might affect the choice of the capital structure that you can use in your business. Next, cost of debt. Cost of debt is connected with somehow the debt you have taken from the particular source. Suppose you have taken a 10 lakh and you have to pay in our example 10% as interest. So this is the cost of that debt, right? Suppose you take a 10 lakh from the market for a wedding, or say your personal work, and you have to pay 10% on your debt. So this is the interest you are paying, or this is the cost of debt taking from the source. So this is how you understand the cost of debt in that particular situation. Next is your tax rate. Higher tax rates lower the after tax cost of debt. Higher tax rate lower the after tax cost of debt. The higher the tax rate you use, your after tax cost of debt would be lower. It means that, for example, if you are having capital structure here and you are paying the 30 lakh, 30% of the tax, so 30% of the 2 lakh is 30,000. But if this interest, if this tax amount is 40%, so 2 lakh, 40% of 2 lakh is 80,000. 40% of 2 lakh is 1,000. 1 lakh is say 40,000. So it will increase from at the hiring tax rate. So once you observe that your tax rate is increasing, and after tax you are having a very less amount for equity distribution, then you should focus on this particular parameters. So this is how it says high tax rate lower the after tax cost of debt. You do not have to pay more tax. You do not have to pay more taxable revenue, more tax on your revenue. So higher tax rates lower the after tax cost of the debt. So it means that if you are paying higher tax, definitely you will be having a less amount of earning after tax in your hand. It will reduce, this amount will be reduced, but in this higher tax will definitely will lower your revenue as well, that is for distribution for the equity share holder. So in this case you should focus on the tax rate. If higher tax rate lower the after tax cost of debt, then it is good, otherwise it is not good. Next, cost of equity. Financial risk increases required returns expected by the shareholder. Cost of equity. Financial risk increases required return expected by the shareholder. As you pay the cost on debt, in the same way you pay the cost of equity in terms of dividend. So financial risk increases required return expected by the shareholder. When your shareholder expect more revenue, more earning per share, more dividend out of the revenue generated, then definitely it will increase the cost of debt or cost of equity, sorry. So definitely you will be in a very tough condition. You will be in a very tough financial risk. You will facing a very tough financial risk. You are facing financial risk in terms of the money that you need to pay on a debt, in terms of equity that you pay to your shareholder. So both condition would be quite tougher for you. Next, flotation cost, expenses linked to the public issues preparation after structure choices. Flotation cost related with your commission, flotation cost related with your underwriting commission, and sometime you are paying interest to the agent. So this is somehow flotation cost will affect your capital structure. So you should be very careful how you have to pay in form of expenses related with the public issue preparations. Public issue preparation in sense you have to subscribe, you have to allow your people to subscribe the shares in the market. So if you are sharing a prospect, you are designing a prospect, and then you are allowing the public to subscribe their share. So sometimes you are paying the expenses of the prospectus, expenses for underwriter commission, expenses for incorporation cost. So these are called flotation costs. So expenses linked to public issue preparation after structure choice, you must be careful about this type of flotation cost. This type of flotation cost should be considered once you design your structure choice. How much money you need in terms of debt, how much money you need in terms of equity. Then you allow yourself to design your flotation cost. How much this type of structure will incur cost to you. Okay, so you must focus on that. Next, your risk as consideration. Overall risk depends on both operating or the financial risk. You need to analyze both type of operating or financial risk related with your business. Next, flexibility. You need to maintain unused borrowing power for unforeseen future needs. Maintain unused borrowing power for unforeseen future needs. As I told you that if you have taken a 15 lakh from the particular source, but you need only 10 lakh, then you must focus on saving that 5 lakh that might be used in your unforeseen or unprojected future needs, or sometime contingencies might arise, so you can use that 5 lakh in that particular situation. So you should be very careful about the flexibility of the money that you are using in your business or you are raising from a particular sources. Next, control. You need to minimize the equity issue project management against the takeover bids. Minimizing equity issues protects management against the takeover bids. So it is talking about the control that you usually handle through what? Through your equity issues, because you are using your equity shareholder, your equity capital for your management point of view, for your organization point of view, for your business point of view. And you have to be very careful about your takeover bid. Suppose any business want to take over you, any business want to purchase your business from you, then you should minimize equity issues, protect management against the takeover bids. Let them think, let them analyze what is the business situation that you are facing right now will help them or not. You should be very careful about its controlling aspect. Okay, so in this case you can focus on important thing. So these factors highlight what? These factors highlight a company may prefer debt over equity because issuing more equity shares dilute the ownership and the control of existing shareholder. This way, by minimizing the equity issues, management can protect itself from taking bids or retain control over the company. It means that if you are issuing less and less shares, so your current owner of the company or the management will have its control over its company. It will not dilute to the outside or any other company who is willing to take over your business. So in this way, you can exercise your control factors before taking the subsequent amount of debt for your company, or they will on issuing less and less equity share for this particular point. Next, you are using the regulatory framework, adhering to the legal norms such as a SEBI guideline. You need to follow the guidelines suggested by the SEBI for this particular type of capital structure that you want to use in your business. And last one is your stock market condition. Bullish market is equity and bearish market condition favor the debt. If your business following or observing the bullish market in the current economy, then you can use more equity. Don't worry. But if our business is experiencing the bearish market condition or bearish economical condition, then you must take the debt instead of taking the equity capital from the equity shareholder. So during the bullish market, you should follow equity. During the bearish market, you will follow debt. This is your MCQs question. During the bullish market, company will follow or taking the equity more and more. During the bearish condition, company will take more and more debt, right? Because during the bearish condition, company would not be able to generate sufficient amount of profit because they will not have to pay to their shareholder. They cannot distribute that returns to their shareholder because after tax they will have a very less amount that we have already understood through our example of 2 lakh, in which they are having a less and less earning per share, right? So during the bearish condition you will use more debt. During the bullish condition you will use more equity. And last point for this condition, for this structure, capital structure of a other company, you should keeping industry patterns. You should keep in mind industry patterns and benchmark as guidelines. What are the other companies are follow? What are the other industries are follows? You must follow the same structure, right? So this could be a benchmark for your company. You should set the benchmark as guidelines suggested by the other industries. What they are using in terms of their capital structure, right? So this is all about for today. Next video we will focus on something important. But thank you for listening this, and if you found this video helpful, then you can like, share, and subscribe, and you can share it to others or other students. People might get more understanding through this particular videos. Okay, thank you very much.